Hello. So today I'm going to be doing a practice problem in regards to the Linter dividend model and how this is used to calculate the expected dividends of a company. So for this example, we use an Altria Group. So it's a large US tobacco company with highly stable cash flows. The firm's dividend is currently $3.92 per share, and this is funded from the earnings per share of $6. So the company has a long-term target payout ratio of 80% and a speed of adjustment factor of 0.3. And these are the forecasts of the earnings per share per year from years 2 to 5. So the first part of this question is explain why Altria Group is likely to adopt a higher payout ratio and dividend smoothing policy. So what's important to know is tobacco companies, due to restrictions and laws that have come into place since since maybe the 70s, I want to say. This has caused them to essentially be, there's no other new tobacco companies coming into the sector because it's very hard. So the existing ones basically just print money because people don't stop using tobacco and there's less competition. So they can't really invest in, there's not many new projects to invest in. So they basically print money. And this is why during high inflationary periods, they're known as kind of cash cows, and they tend to have quite high dividends. If you think of something like Imperial Brands or American or British American Tobacco. Anyway, so the question is asking why would they likely adopt a high payout ratio and dividend smoothing policy? So they'd adopt a high ratio because they essentially don't have many other projects to invest in. So not many projects to invest in. So if a company were to have projects with a high NPV, net present value, then they'd maybe consider reinvesting their profits into these projects. But in this case, for a tobacco company, there's not much they can do to improve. It's kind of just keeps going on. As well as this, they have stable cash flows. So a company doesn't want to give a high dividend. So, they don't want to pay out 80% of their profits to shareholders if it's going to be unstable, because what often happens is, and this relates to the speed of adjustment factor. So a company doesn't want to cut a dividend basically, because that would then signal not much confidence to shareholders and the stock price would drop. So companies are usually quite cautious and conservative with this, and they try to keep it, maintain it, or not increase it to an amazing amount and then have to cut it, because that would the stock price would go down if they had to cut anything. So that's one of another reason they don't want to cut dividends. And in this case, they have very stable cash flows. So there's no risk essentially that they're going to have, a terrible month or an amazing month after that. Great. So these are some of the main reasons. I've just bullet pointed these. So now I'm going to move on to part B. So assume the firm proceeds with a dividend of $3.92 year one. Calculate the expected dividends per share in years 2 to 5 using the Linter dividend model. So first, I'm going to create a table for the years. So year 1, 2, 3, 4, 5, and then we have the earnings per share, which we have up here, EPS of $5.50, $6.50. $7 and $7 in the year 4 and 5. And now we're going to find the expected dividend. So we're just going to basically divide the earnings per share by the payout ratio. So in this, so it's 80%. So $5.50, 0.8, that gives us 4.4. Then we're going to have the actual dividend over here. And then the paid dividend of, and then earnings per share, $6. Whoops. So now we're going to use the Linter model. So for year 2, we have the original dividend of year 1, so 3.92, plus 0.8, which is the speed of adjustment factor. And then we're going to do the expected dividend of $4.40 minus 3.92. That's going to give us $4.30 approximately. And now we're going to do the same for year 3. So now we use the $4.30 plus 0.8, $5.20 the expected minus $4.30. That gives us $5.02. I'm just going to keep doing this for year 4 and 5 now. Great. So now we found the dividends for every year from year 2 to 5. Now, so explain the determinants of the long-term payout ratio and the speed of adjustment factor. So I kind of mentioned this before. Long-term payout ratio is essentially what a company is willing to pay out based on whether they have investment projects that could offer large returns or not, or if it's better value to simply pay out dividends to shareholders. As well as this, oftentimes shareholders have a preference. So, certain companies may have been bought because they have good dividends, and in the future, investors may want to keep this on. So they'd rather that management pay out dividends as opposed to investing in internal projects. Whether a company has sufficient access to capital markets or other forms of equity. So, for example, if they're able to raise money through, some taken on some form of debt from a bank, venture capitalist, anything like this, then they would be able to pay out the money. But if they didn't have access to these forms of debt, then they would actually have to keep a lot of that their earnings and profit to reinvest in order, to be able to keep investing in the company. It's quite self-explanatory. And then the speed of adjustment factor. So, this is how quickly the management changes the dividends. So if it's lower, then they don't want to, essentially management doesn't want to keep changing dividends too quickly, because they want to stay conservative. They don't want to cut dividends, as I said before. So that's one of the biggest factors that determines this. So yeah.